All right, welcome everybody. My name is Frank Farina. I'm Associate Professor here at Catawba College, and I'm the Director of the Catawba College Institute of Business and Accounting. We're offering this course today in partnership with Statewide Title. It's entitled 1031 Exchanges. We have Chris Birdie, Esquire. Chris is an attorney who is a qualified intermediary. You'll learn all about that later on. Chris went to East Carolina, undergraduate, went to UNC Chapel Hill for law school. He's been doing this for a long time. I won't embarrass him by saying how many years, but a while. And I think you'll learn quite a bit. And we're here at the Catawba Center for the Environment. It's a beautiful facility. So hopefully you folks who are online will be able to come in person next year, and you'll enjoy the facility. So without further ado, here's Chris.
1031. What's 1031? Well, that's basically the section of the Internal Revenue Code that is the home for this concept of tax-deferred exchanges. They're also called, in the common parlance, like-kind exchanges. And we'll talk about why in a minute. They're called starker exchanges. That's a little historical note. We'll talk about that in a minute. They're called tax-free exchanges. We're not going to use those words because there's no such thing. It's a misphrasing of it. What they are tax-deferred exchanges. They are not tax-free. It just means that the tax, if any, is accruing, or if any losses are going to be recognized, those will occur at a later point in time. Now, there was Frank alluded to my East Carolina education. I was a business management major. And in the finance courses that I was took at those point in time, all my professors said the same thing, okay? Never pay today what you can pay tomorrow. So the basic tax philosophy is to defer taxes if at all possible. And that's what the whole concept behind this. The history was we started out with the idea of being able to do 1031 tax-deferred exchanges beginning of their entry into the code in 1921. The code acknowledged that you could do tax-deferred exchanges. Didn't do much to tell us how to do them. Okay? In 1984, we had a tax court case called Starker, Starker versus Commissioner, and in that case, the people were doing what is called a deferred exchange, not a tax-deferred exchange. Actually, the exchange itself was deferred. Now, in the original days of 1031 exchanges, what people would do with a real estate exchange, for instance, is they would sit down at a closing table and they would hand each other deeds. And that's a contemporaneous exchange, simultaneous exchange. And that was the way the code was written, and everybody understood that was fine. Well, the problem with that is that a lot of times people have an opportunity to sell a piece of property, okay, but they're not exactly sure about the property they want to swap it for at that point. They haven't identified the property that they want to replace it, if so, sometimes it's not going to be able to be done at the same time, contemporaneously. And so the problem became, well, how can we figure out a way to do this exchange but not do a table swap like we described initially? And that's where deferred exchanges came in. People would do contractual methods to do that, but they weren't approved with any specific tax court cases. They weren't approved by any specific IRS-engendered regulations, no law mandated by Congress. They were just the deals that people were cooking up. And eventually in the 1980s, the Starkers did one, and they did one, under the contract basis that everybody was doing at the time, and the IRS challenged the qualification, the ability to do that deferred exchange, where they sold property at one point and bought another piece of property at another point and used the money to buy that replacement property and treat it as a swap, an exchange. Well, the IRS didn't like that, and they challenged it on it. They imposed taxes and penalties. The Starkers took it to court. They contested the IRS's position, and they were vindicated in court. And at that point in time, we had a judicial recognition that you could do a deferred exchange, sell at one point in time and replace at another point in time. But again, we had no cookbook. We had no instruction manual. We didn't know with certainty how to do that, and because of the amount of business being engendered by these things, Congress mandated to the IRS that certain regulations be adopted to create a procedure for doing deferred exchanges. And they did, and they adopted those in 1990. Now, Frank was being very kind and not mentioning how long I've been doing this. I will just say this. When I was in private practice, I did exchanges under the Starker case before the regulations for our clients. So I did go back a long way with these things. But that's generally the history of how we got to where we are today, where you all are sitting in a room to do this. Because what happened in 1990, and to a degree as it has evolved since then, is that the IRS adopted regulations that created safe harbors. They created a cookbook. They created an instruction manual that will now allow tax practitioners and taxpayers to structure transactions with both real estate and personal property to permit a qualified deferral of income tax recognition. And that's the whole nutshell about what this is about. And my computer or my battery's gone to sleep. Let's see what happened. There we go. One little flavor, in 2000, and we'll talk about reverse exchanges later, we got a revenue ruling that authorized the idea of a reverse exchange. For now, in the basics, until we talk about it in a little more detail, a reverse exchange is a regular exchange with bad timing. Okay? We'll talk more about what that means, but it is what it is. The selling of real estate with the IRS in some shape or manner is, under the regulations and under the tax code, a taxable event. Now, being a taxable event doesn't necessarily mean you have to pay taxes. You can have tax losses, okay? And you can factor those losses into your income, but it's a taxable event. It's the recognition of gain or loss on the sale. And so that's the reason when we're talking about property, business property primarily, but in certain cases even personal property. By the way, if you didn't realize it, most of you probably don't realize it, especially the younger people in the room. If you buy a car on Craigslist and get a really good deal, keep it a year, and sell it for a profit, you're supposed to report that on your income tax. How many of you do? Don't raise your hand. Okay? What the IRS regulates, what the code says, no gain or loss shall be recognized on the exchange of property held for the productive use in a trade or business or for investment if such property is exchanged solely for property of like kind. Told you to tell you about like kind, which is to be held, operative term, either for productive use in a trade or business or for investment. Okay? This is the core of 1031 tax deferral. If you have a qualifying property, it's done in a qualifying exchange, any gain or loss recognized on that transfer will be deferred to a future point in time. And that's essentially what the whole process is about. The way this works is in North Carolina, the maximum income tax rate right now is 5.75% for high-income taxpayers. The federal maximum capital gains rate is 39.6% for high-income taxpayers. The combined 2015 tax bite would be 49.35% if capital gains were not recognized. So you have to recognize that theoretically, with no capital gains at all at play, half of a sale could be taxable. We were talking about what a qualified intermediary is. Well, within the safe harbors created by the regulations promulgated by the IRS in 1990, they created a characterization of one of the parties to an exchange, and that's called a qualified intermediary. And you got to love the tax code. You have to love the tax code. It doesn't define what a qualified mediary is. It will define what a qualified mediary isn't. It can't be this, it can't be that, and we'll talk more about that, but it's ironic that they don't tell you what one is, but they'll tell you what one isn't. Okay? It's an unrelated third party. All right, relinquished property, another term we got to get hold to. We'll talk about relinquished property, relinquished, maybe without the articulation, RQ, okay? In an exchange, the idea we talked about initially was we would have a table exchange, swap deeds. With a deferred exchange, typically you have a sale treated as not really being a sale, and a purchase treated as not really being a purchase, and the combination of those two transactions together being an exchange or a swap. All right, the relinquished property is the property that the taxpayer is getting rid of, selling, okay? And the replacement property is the property they're using to replace the relinquished property to complete the exchange, okay? So those are terms that we'll be using consistently throughout the rest of this presentation. Safe harbors, those are conditions. If met, the IRS has said, and this is beautiful too, the IRS doesn't say your exchange is good, okay? It says we won't challenge your exchange. So it's a get-out-of-jail-free card is really what it is, all right? The guidelines ensure that exchanges will pass scrutiny. They include certain things like one of the things that you must have, okay? Even if you still today have a contemporaneous, simultaneous exchange, table swap, okay? You still have to have a written exchange agreement that says we're going to swap so that you can take advantage of a Section 1031 deferral. You still have to have an exchange agreement. If proceeds are involved, money is passing, changing hands, you will have to have a non-disqualified intermediary, which of course will be called the qualified intermediary. Okay? You have to have a written replacement property identification provided to the qualified intermediary by the end of the 45th day after which the property has exchanged hands. The closing on all replacement property must occur by the end of the 180 days. This is what was not laid out in the Starker case. This is what created a great deal of consternation after Starker, particularly for the IRS, was when the court said you could do a deferred exchange, the court offered no guidelines as to how long it had to be before you completed your exchange. In this case, 180 days under the regulations, but then conceivably 1 year, 2 years, what was reasonable or unreasonable was left up in the air by the court. In order to foreclose all that litigation, Congress mandated these regulations, creating these safe harbors. We now have an absolute 180-day limit. Boot. Okay? For all you good Southerners, it's not the trunk of your car. Boot is cash, cash equivalent, or any non-like kind gain. In other words, other property that's not qualified as like kind. Proceeds equal money netted from an RQ sale held by a qualified intermediary. Basis, we're not going to get into the technical ends of what basis is. We'll be talking about some big principles because they do factor in, but really that's crunching the numbers, and that's beyond the scope of what we do today in terms of a real technical analysis of basis. Generally, so you know we're talking about that, big sort of general term that encompasses a lot of ills and a lot of exceptions. It's the original purchase price of the relinquished property, and the adjusted basis is the basis less any depreciation allowed, plus the cost of any capital improvements, plus or minus any required accounting adjustments. And that's the math part. I'm a lawyer, I don't do math. At least not anymore. Gain realized, now you have gain realized. That's a difference between the sales price and the taxpayer's adjusted basis. The gain recognized is what the IRS says is the portion of the gain that is currently taxable, and that either taxable as a gain or a loss. Okay? Questions? None there? Held for, we had accentuated as a term of art. Held for means the reason that you possess this property. And it is the purpose that goes to a lot of the more complex questions we'll be doing in the second half of this presentation. But it is the intended use of the property or the purpose in acquiring that. And we alluded to that earlier in the definition, and that those are held for investment. All right, that's okay. You can hold it for investment, hope it'll grow in value. You can hold it for the use of a business. If you have a retail store that your business owns, then or you own on behalf of your business, then that is used for the production of income. Rental property is used for the production of income. Or it could be property that's used in the business itself, and that would be like a mine, for instance, where they dig up the earth itself. Okay? Like kind is a tricky question because it is very, very specific with regard to personal property. It is very aspecific with regard to real property. The IRS does not care about what's sitting on the real estate, okay? What its actual specific use is for, like residential use, commercial use, industrial use, vacant land, doesn't matter. It is dirt for dirt with regard to real property. It is the character of the holding, those three items we talked about: production of income, use in a business, or investment. Personal property has the same holding issues, but they also add a layer of complexity within the regulations in that the personal property has to fit certain IRS-defined asset classifications. So you cannot do a 1031 exchange and exchange a boat for a crane, okay? But you can exchange a big bulldozer for a little bulldozer. So you'll have these sorts of characterizations. The really interesting thing is within the body of the regulation itself, outside of this asset categorization, the IRS, as one of its examples, and it has multitude of examples in the regulation, one of the examples is an exchange of a herd of cows for a herd of steers is not like kind. So apparently there's a significant difference in the asset category between cows and steers. Okay? Non-qualifying personal property is personal residence, property used for personal enjoyment, a vacation home, dealer property. Okay? Inventory held for sale isn't one of those three classifications of held for that I described earlier. Held for sale is completely different, and you have to pay taxes on any gain or recognize any losses for losses in any transactions when you are conveying inventory. Now, with regard to a factory, manufacturing concern, all that's pretty obvious. That's what they're doing business in, so they know what their inventory is. Where it gets much more clouded and much more confused is in the real estate arena, because a developer typically sells inventory. And typically, a developer cannot do a 1031 tax treatment of the developer's inventory. And the question comes up, well, can a developer ever do a 1031 transaction? And I said, yes, but it's biblical. And people look at me with great questioning eyes. What do you mean biblical? So I said, well, it's easier for a developer to pass through the eye of the needle than it is to do a 1031 and have it qualify for a 1031 treatment, because almost always they will be holding property for sale. But there are cases, there are revenue rulings, there are private letter rulings dealing with the situation wherein the IRS has explicitly recognized that if the developer actually is holding it for investment legitimately and not for resale, then yes, they can do a 1031 exchange. And so it just gets tricky, not harder. Okay? With regard to personal property exchanges, the IRS says you can recognize the North American Industrial Classification System codes, and so if the property that you are getting rid of and the property that you are replacing it are all within that one code, they'll be treated as like kind. Okay? So that makes it a lot easier to do that than it used to be in the old days. Information system hardware, office furniture, vessel, barges, tugboats, airplanes, helicopter, rail, these are all typical asset classes. And then you go in with those classes within a specific code and find out if they're thing. So, to give you an example of how this might work by the numbers, I have pre-done the math. I've checked it. Hopefully, Frank proofed it. He proofed everything else very thoroughly, so I'm hoping he did the math too. Taxpayer sells land in North Carolina with a taxable gain of $100,000. On the sales side of the transaction, this is for a pure sale. The federal tax rate for this taxpayer would have been 15%, would have been $20,000. The North Carolina rate, we'll assume they're a high-end taxpayer, 5.75%, $5,750. Total tax on the sale, $25,750. Now, this is obviously a stripped-down hypothetical transaction because we haven't done any of the basis adjustments or anything like that. It's just for an example. But for the reason that people do 1031 exchanges is the total to reinvest, if they wanted to remain invested in real estate, would now be just under $75,000. So they sold a property with a gain of 100 and they're down to 75. They've lost their leverage in the investment market of that $25,000 more or less they paid in taxes. Okay. Now, if this were handled as an exchange, federal rate, taxes are deferred, no recognition of federal taxes. North Carolina recognizes the same taxing treatment, no recognition under North Carolina law. Total tax, zero. Total amount to reinvest, $100,000. A much more potent investment kitty for somebody who wishes to remain reinvested in real estate. So that's why parties would do a 1031 exchange. If we abolished capital gains with a max rate of $49,000, we would have basically cut that in half. So you can see why you would do it. With regard to a real property exchange, we've talked about relinquished property. We replace it with like kind, and it has to be a qualified use. We talked about those factors. But again, I want to emphasize, when you're dealing with real estate, it is not the character of the property. You can't do 1031 on your personal residence, your home. Okay? You can't do it on your vacation home, because those are held for specific uses. One to live in, the other to live in on vacation. Okay? It's for personal use. But residential doesn't take you out, because rental property, residential real estate, a single-family residence, an apartment complex, okay, a condominium, those can all be exchanged if they're held for the production of income, such as rental. You could swap those for a factory, for a shopping center, for a farm, for a vacant piece of land, for a sand mine. Right? And no issues in that regard. So it's not the character. The time period that we need to deal with regard to an exchange is we'll start with day 1 and day 180. This is a critical time period under the code. There are no grace periods. Okay? There's no, well, that was a good faith effort. We'll kind of let you slide this time. It's not like rolling through a stop sign unless you got a rookie cop, in which case they will always give you a ticket. And the IRS will always give you a ticket in this situation. The court will cut you no slack. Day 1 is the day that title transfers. With regard to possession of personal property, that's usually delivery of the property itself. With regard to real estate, it gets a little bit trickier. In real estate, a deed transfers title. In states like North Carolina, it's typically treated as transferring title when you record it. But actually, the old cases say that title transfers when the recipient of the deed, the grantee of the deed, gets the deed with no conditions, whether or not it's recorded. So you have to be very careful, because there are situations where you can have a dry closing, all conditions are met, the seller says, I've got my money, it's your property. The buyer says, I know you can't get to the courthouse, I'll take that risk. My 180 days is about to run, and you can do that. But you have to be very careful and rely on opinion of counsel. So day 1, title transfers, personal property or real property, that starts the clock, okay? And it becomes a very, very steady transition from that point. All right, that closes, starts your exchange period, your day 1. Then you have an identification period. The IRS requires you in these regulations, in these safe harbors, to stake yourself out and say, this is the replacement property we're going to use. And the reason is they want to identify this as a real exchange of specifically identifiable property rather than just some generalized intent. Well, yeah, I'd like to do an exchange, maybe, more or less, sort of. You got to stake yourself out. You got to identify it, and you got to identify it with specificity. And you've got to do it within 45 days. And there are other requirements that we'll talk about. Okay? So that 45 days is absolute. If you identify no property, or if you don't identify the property as in the manner required by the IRS within 45 days, your exchange is done and your tax deferral is done, and you're going to have to report that income on the next year's tax return after that 45 day. Then there's an 180-day exchange period, but it doesn't start at the end of the 45-day period. The 180 days is overlapping. You have 180 days total. No grace periods. Now, there's a court case, tax court case, and it's really, really interesting reading because the facts were really hardship. The people entered into an exchange in good faith. They identified their property in a timely fashion. They did everything they were supposed to. They got a good, qualified intermediary. They had a written exchange agreement. A, B, C, D, dotted every I, crossed every T. And then they set the closing for day 179. And the seller backed out of the deal on day 179. Okay? Just said, nope, sorry, I'm not going to sell the property. So they couldn't close on their identified replacement property on day 179. On day 180, I think, they found and closed on a replacement property. And the court said, you did everything that you could do. The tax court said, there's no question about your good faith in this. However, I am not at liberty to rewrite the law. So basically, there are no grace periods, not even for honest, able, good faith players. So it's a very critical period. That day 180 is written in stone. And by the way, if day 180 is on Sunday or a holiday, does not matter. Does not matter. It expires 180 calendar days. Okay. Oh, got myself a little reminder. You know, there's always a gotcha in the tax code. This one also has a gotcha in the tax code. Either the 180 days or the due date of the taxpayer's return. Okay? Now that gets really, really quirky with regard to corporations. We're due January 30th unless they're extended. And an ordinary taxpayer, calendar year taxpayer, on April the 15th. If you do a 1031 exchange and open up your transaction exchange after October the 15th, then you're going to run out of your 180 days before your tax return is due. And the IRS does give you an out on that. You have to file an extension. You don't have to use the extension, but you got to file it, and it's a mandatory requirement. So there's a gotcha in there. All right? Now, with regard to the funds in this upfront sale, taxpayer can have no actual or constructive receipt of the proceeds. That's what the whole thing, qualified intermediary, is all about. The qualified intermediary is sort of like the rubber around the extension cord. It's to keep you away from the fire of the electricity, or in this case, the ire of the IRS. They're your insulator on these proceeds. Okay? No actual or constructive receipt of the proceeds. What is actual receipt? Well, obviously, if you go to a real estate closing and the closing attorney hands you a check, you've got the money. Okay? The fact that you didn't cash the check is irrelevant to the IRS. Okay? So receipt of any money or property, the receipt of any economic benefit. In other words, if you have the right to control the funds in any way, shape, or form, a fiduciary right, beneficial interest, anything of that nature. Economic benefits include the right to use the funds as loan collateral. So basically, if you have all these funds in a 1031 qualified intermediary's account, but you have the right to put it up as collateral for a loan, then you have basically gotten actual receipt of those funds, not just constructive receipts. Okay? The right to receive the money. As a 1031 qualified intermediary, we are constantly presented with a set of facts where at a closing, a taxpayer has been presented with a closing proceeds check, or they've been deposited in the closing attorney's trust account for their benefit, which means they have the right to demand those funds. They have the right to cash that check, and once they have that, they have actual receipts. And so these are all disqualifying actions with regard to the funds. So checks are a bad thing. Okay? Credited to the taxpayer's account. Now, in North Carolina, almost all closings are conducted by closing attorneys. And the closing attorney will fix this for me. I turned it off once. The closing attorney will handle the closing, handle the disbursement of the funds, and in a standard non-1031 transaction, will typically receive funds on behalf of the seller in the attorney's trust account. Okay? So if they're in the attorney's trust account in the taxpayer's name, they've been credited to their account. They're available then because the attorney in that case is a fiduciary and must do as the taxpayer directs them to do. And as far as the IRS is concerned, that's the same thing if you got gold bars in your pocket. You've received it. Okay? If it's set apart for the taxpayer, same sort of thing. If it's available to draw on at any time, in other words, if the taxpayer has any direct access, then that's it. What is not constructive receipt? If the funds are subject to substantial limitations. Now I'm going to give you a little mini explanation carved into what we do with an exchange agreement. In a qualified intermediaries exchange agreement, it's going to say you can't get this money except pursuant to the terms of this exchange agreement, period. Now that's cutting about 30 pages of legalese down into to one sentence. Obviously it's more complex than that. Okay? So, because the taxpayer under certain circumstances has a right to those funds, all right, it's not disqualified because the contract imposes substantial limitations on their right to access those funds, and those limitations are what insulate it. That's the plastic on the power cord. Constructive receipt when the limitations or restrictions terminate. Okay? In the typical standard exchange agreement that you will see, it will say that if no exchange is consummated within 180 days, okay, then the money will become the taxpayer's. And that's when the conditions terminate. And at that point, there is no exchange, so it doesn't matter. But yes, there is constructive receipt, even though it's in the qualified intermediary's account at that point. Okay? An agent is an actual constructive receipt. Okay? An agent would be a real estate agent. It would be the attorney's tax advisor. It would be, the taxpayer's tax advisor preparer. It would be their broker, their mortgage broker, their investment broker. If one of those parties has the money, that's constructive receipt of the funds. All disqualifying events in that regard. There are no early disbursements other than is expressly provided, and that would be if all identified replacement property has been acquired and the identification period has ended, okay, then there's no more ability to do an exchange with those funds. And since there's no more ability to do an exchange with those funds, it's basically going to be an actual receipt issuation. They're going to pay taxes on the surplus funds anyway, but it will not be a violation of the exchange agreement, will not create a constructive receipt of the whole fund. If you break the rules, you can actually taint all of the exchange funds. Okay? Contingency beyond the taxpayer's control. I think in almost 20-something years of doing exchanges, we've had 2 of these this year, and I think for the first time. Jeanette's nodding, I'm right. The contingency beyond the taxpayer's control is, let's suppose they've identified one piece of replacement property. The 45 days has expired. As a result of that, they can no longer identify any more replacement property because we've said that 45 days is an end-all be-all, drop-dead date. And on day 46, the identified The owner of the identified replacement property takes it off the market. Says, I'm not going to sell it. Okay? That is completely outside of the taxpayer's control. And at that point in time, they can no longer do a qualified exchange. And as a result, that's one of the limitations, one of the contingencies that the IRS has said. As long as it's out of the taxpayer's control, that can go ahead and they can get their money early. Okay? Qualified intermediary's got to be an independent party with respect to the taxpayer. Can't be the taxpayer, obviously. Can't be an employee of the taxpayer, a relative of the taxpayer, attorney, tax advisor, broker, investor, or any of those things. Got to be an independent party. There is a tax court case a number of years ago, back in, I want to say the 80s. No, it's got to be the 90s, excuse me. And what happened is this qualified intermediary was basically a small storefront operation. Didn't have good counsel apparently or experienced personnel, and basically they did whatever their taxpayer customers asked them to do. And the IRS came in there and disqualified one taxpayer's exchange. But the really striking language of that tax court case was basically they said these people do anything that their folks will tell them to do, so basically they're not a qualified intermediary. Now, what impact did that court's sort of conversational comment in that one case have on their standing as a QI for everybody else they ever did a 1031 tax deferred transaction for? You've got to make sure that your qualified intermediary knows what they're doing and that they consistently play by the rules, because the characterization can actually ruin them. Okay? So no qualified intermediary control. Okay? Your basic exchange structures that we'll be talking about today will be, magic word, forward exchange. You could call that a regular exchange. That's probably 95+% of the work we do. Okay? They're almost always a deferred exchange time-wise. There'll be a sale of the relinquished property, and within the time periods of the safe harbors, there will be a subsequent purchase of the replacement property. And the transaction will go like clockwork. That's a forward exchange. That's the ones you can almost do as a cookie cutter approach, as long as you don't try too much tweaking. And I can guarantee you the taxpayers will try to tweak everything they possibly can. But that's the whole thing about safe harbors, is you do them according to the cookbook and you're okay. You vary at your own jeopardy. Okay, so that's a forward reverse. A reverse exchange I alluded to earlier, and we'll talk in more detail about what a reverse exchange is. A reverse exchange is done, and very quickly and briefly to kind of foreshadow where we're going with this. Once a taxpayer takes title to a piece of property, once they own a piece of property, all right, that taints it, prevents them from using that property as replacement property in an exchange, because they already own it. I mean, they could sell it, come back years later and buy it, but that's another story altogether. Okay? So if they acquire property and then sell a piece of property, they can't take the property that they just bought, okay, and use it as a replacement property that they sold after they owned it. It's kind of like, you know, if you buy something at a department store and then they put it on sale the next week, they're not going to give you a discount. And the IRS sort of plays by the same rules. Okay? A reverse exchange means that a tax-exempt entity will buy the property on behalf of the taxpayer, hold it until the relinquished property is disposed of, and then complete the exchange. So it's just a forward exchange with bad timing, because the timing of the acquisition of the replacement property is not convenient for tax deferral. Okay? A bill to suit is a complicated reverse forward exchange, because what you do there is you have property that we'll just say is a vacant lot for explanation. Okay? If you buy a vacant lot as part of a 1031 exchange replacement property, once you buy it, you own it. If any improvements that you do to the property after you own it cannot qualify under any circumstances as like kind. That's in actually 3 or 4 examples of that in the regulations. It's unequivocal. It's not subject to interpretation. The IRS has expressly given us examples in the regulations that say you can't do that. So let's suppose that they sold a property for $500,000. They got to replace it with $500,000 property. They got a $100,000 lot. They want to do $400,000 of improvements to it, or even $700,000 of improvement to it. Build-to-suit exchange will put the title to the property in that special purpose entity for the process. There will be certain provisions written up, contract complying with the safe harbors. The improvements will be done, and then at the end of that period, and the exchange funds will be used to do that, and then the end of the exchange period, if it can be done within 180 days, will be then turned over to the taxpayer and complete the exchange. It's complex, it's tricky, there's a lot of moving parts, but it's doable and it's expressly authorized in the regulations. Okay? Some examples, we'll find out how these slides work on the screen. They seem to look real good on my computer. I don't know. We'll find out. Okay? These are all your parties. You got your 1031 exchanger. That's your taxpayer. You got your relinquished property buyer. You got your qualified intermediary, and you got your replacement property seller for your tax-deferred exchange. Typically what happens is you're going to have a contract between the exchanger and the qualified intermediary assigned. In other words, there will be an assignment of the sales contract that the taxpayer had with the RQ purchaser that will be assigned to the qualified intermediary who will close it in their shoes, so to speak. Okay? The next thing that you'll have is you'll have the cash from the buyer for the purchase going to the QI to put in the taxpayer's account. Again, the QI is insulating this cash from constructive or actual receipt. There will be allowed under the IRS regulations a direct deed from the taxpayer to the buyer. Now, under Starker, before we had these safe harbor regulations, more often than not, the IRS would push for the fact that the deed would go to the QI and the QI to the buyer. And the problem with that are liability issues, both environmental and personal injury type of liability issues. Qualified intermediaries don't want to take title to land. When they do them in regard to reverse exchanges, they set up a single-purpose, single-use LLC to do that, to preserve those liability issues, protection issues. And so rather than have them take title, the IRS says, okay, we give up. We'll let you, as long as you do everything else, have the exchange agreement, handle the money properly, do everything by the book, we'll let you actually make the deed straight to the buyer. And so that happens. And then when the replacement closing time comes up later, which is the deferred aspect of the exchange, then basically you get another assignment of contract, you get cash running from the QI to the seller, and a direct deed straight back to the exchanger. Okay? Is that too confusing? Okay. Great group. Either that or no one's got the guts to ask the question everybody wants to know. And I never know which it is. In 2000, the IRS had alluded when it issued its 1990 regulations that the question of reverse exchanges had come up, and the IRS said, we admit that you can do reverse exchanges. However, in these regulations, we're not telling you how to do them. Okay? And so between 1990 and 2000, a full decade, people were doing reverse exchanges as best they knew how. But basically, were doing them in a qualified aspect that whoever was structuring these was saying to them, unless you get a private letter ruling approving this exchange in advance, we're doing the best we can promise you no results. And then a revenue procedure was issued by the IRS in 2000, and that one they basically came in, extolled another whole set of safe harbors for reverse exchanges, and really opened up the rules a great deal more than what people were doing when they were just trying to do it safe as they knew how. They authorized a great deal of activity that's commercially reasonable that the older revenue rulings, the older tax court cases would have suggested would not be permissible. And they basically, my way of characterizing it when it first came out was, well, you know, if it's a thing that you would typically do in business, as long as you don't run across these safe harbors with regard to constructive receipt of funds, the IRS said anything goes. And they're very, very broad authority in that revenue procedure for business things. One of the things that the taxpayer can do is lease the property back from the special purpose entity and occupy it and use it. Now, everybody would have said in the old days you couldn't do that, but the IRS actually said, yeah, you can. So we'll talk more about that in the advanced section. But basically, the term we use is parking. You know, it's parking because it's put in this special purpose entity to be parked there until it's time to transfer it to the taxpayer. So parking is a term of art. I hated it when they first came out with the regulars. It's an exchange accommodation title holder. Only the IRS and the government could dream such an awkward name for a single purpose entity as exchange accommodation title holder. Okay? Qualified indicia of ownership. That could be a long-term lease, it could be an option to purchase, it could be a whole lot of things. Basically, indicia of ownership is any sort of way of holding property under state law that you will be treated as the owner. That's what that grand term means. It means you're treated under state law as the owner of the property. Permits loans to the qualified intermediary by the taxpayer or guaranteed by the taxpayer. Simplifies the money process hugely. Allows prepayment of the loans, make clear provisions. Now, the way a reverse exchange would go on our little bubble schedule, Zen chart, okay? Got our taxpayer. We got the LLC, which is the special purpose entity we talked about. Good qualified intermediaries will use this one time and one time only for liability reasons. Replacement property, first leg, second leg, dividing line, QI in the middle, taxpayer, the relinquished property, and the RQ buyer. Okay, there's all of our players. Same taxpayer, it's just awkward to show on one slide, so that's why we've done it this way, to try to think. These are the same, just a different part of the transaction. In the first leg, this is typically the acquisition of the replacement property. Why would somebody do a reverse exchange? Well, we talked about the bill to suit because they need to do improvements on it. But typically what happens is they have found a wonderful deal on a piece of investment property, business income producing property, whatever, and they really, 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 really want to buy it. And the seller of that property will not extend the time to close the transaction in their contract. And the taxpayer has not yet sold their relinquished property. In fact, they may not even put it on the market yet. They don't know how long it's going to take. So in these circumstances, they can't take title. But they really need to close in order not to lose the deal. And that's why you do a reverse exchange. Now, by the way, to put things into perspective, there's always the legal aspects, and we're talking a great deal about that this afternoon. Okay? There are also practical aspects that flavor these transactions mightily, and this is probably a good time to stop and point that out. Okay? The cost for the QI fees for a reverse exchange probably starts at a low end of about $4,000, goes to a medium high end of somewhere around $10,000. Okay? You're not going to do a reverse exchange to shelter $4,000 in income tax just because you can, because it's obviously just throwing the money away. So you have to remember there's an actual out-of-pocket cost for doing these things, and you can't let just doing the deal outweigh the actual financial gain of doing it. Sometimes it's just better to go ahead and pay the gain, and when you do, you get an increased basis.
And what happens with that $4,000 to $10,000? If you do this, what does that become the basis of the newly acquired property? What do you do with that? How does that transfer to the tax?
Typically, it doesn't go into basis because basis, of course, is a capitalization cost. Typically, it's considered, I think, a deductible closing expense. So it can either be taken out of the exchange fund. Almost always it's taken out of the exchange fund. Occasionally we'll get a few people that will deduct it on their return but that's rare. but it's usually a deductible transactional expense. Anybody get lost on that one? That was a pretty tax accounting question, kind of technical.
Ask a question about on the constructive receipt, the earnest money deposit, does that qualify in a commercial transaction as part of a constructive receipt? So where the taxpayer is receiving earnest money deposit during the contract period prior to the actual closing.
Okay, that's probably better served in the accounting section. But the question for those online was, if the taxpayer during the transactional process receives the earnest money deposit, how does that basically is accounted for in a tax deferred exchange? And basically, the general rule is they receive the funds. And so they will receive no deferral with regard to the earnest money that they put in their pocket. Now, there is an exception, and we'll talk more about that when we talk about deposits in the advanced accounting section. So I'm going to beg off because we still got some territory here to cover, but it's a great question, and don't let me get past it when we get to there if I'm motoring along and in the zone. Okay. In regard to the first leg of the transaction, this is the acquisition of the replacement property, and what typically happens, you assign the contract to the qualified intermediary, then they then assign the tract to the LLC as the EAT. Cash goes in there. They buy the replacement property in that transaction. Then the deed goes back in the name of the EAT, which will be typically an LLC, as we single use, single purpose. Okay. Then, before the 180 days expires, the taxpayer will then assign the contract for the acquisition of the the sale of the relinquished property to the QI, and from this end of it, it now proceeds like a forward exchange. We sort of fixed the timing. The bad timing has been corrected, and just like a forward exchange, the cash goes from the buyer to the QI. The deed is transferred directly to them. Loan is paid off with the LLC with the cash from that transaction. And then one of two things will happen. If the taxpayer is an individual, the IRS has said that if you have an LLC that has elected pass-through tax treatment to be treated as a partnership, not a corporation, and it is a single-member LLC, and you have a single taxpayer, the IRS will basically treat them as one and the same, in which case, in a reverse exchange, the taxpayer can do one of two things. They can elect to take a deed, as we showed on this example, or they can actually, if it's an individual taxpayer, they can take an assignment from the qualified intermediary of the membership interest of that LLC and retain all the benefits of holding business property in an LLC. And why we don't have 90% of our people doing that, I have never figured out. When we started doing these things in 2000, and we structured the transactions to start handling these things when the safe harbor, our business model was, well, everybody in their right mind is going to want it to be an LLC. And it's turned out to be almost, have we done 5 LLC assignments? Maybe? Maybe. By the way, Jeanette, please stand up. I'd like to introduce you. Jeanette is the head of operations across the state and north for Statewide Title, and the head of operations for our exchange subsidiary, Statewide Title Exchange Corporation. Thank you. And so she just basically herds all the cats in our STEC department. And when it comes to all the administrative details, she's way ahead of what I know. My problem is answering weird questions. So anyway, that's the way those things will be typically structured in a reverse exchange. A bill-to-suit exchange is sort of a hybrid of a forward exchange and a reverse exchange. Same 180-day period. Taxpayer can't own the property as improved. EAT is a party to the construction agreement. Strict rules for disbursement in the regs. 100-day exchange period the same way. And basically the way it is, again, you sign a contract to the QI. The buyer puts the cash up to the QI. The QI then has a direct deeding to the taxpayer with regard to that, but it goes to the EAT instead. And then the seller for the replacement property puts the money in the EAT, the cash comes in from the QI to the seller, the improvements go into the builder, contractor who's doing the improvements. Once they are completed, then the property is deeded from the exchange accommodation title holder to the taxpayer. It's kind of a really crazy Zen chart, but it makes a sort of esoteric sense once you played with a few of these. Questions on it? Everybody too embarrassed to ask? Okay. All right, we'll talk more about it later, maybe get some. Now, one of the things that everybody forgets is the qualified intermediary doesn't do tax returns. Okay? We don't prepare tax returns. Taxpayers got to do a special reporting, it's an 8824 that's been done. If you have any involvement with a 1031 exchange, always remind the taxpayer they're going to have to submit this form in the year of the tax year of the exchange. Okay?